Hey everyone, and welcome back to another portfolio update video for today. So after a couple of weeks of outperforming the S&P, we are now underperforming. Over the past week, we are down 3.17%, whereas the S&P 500 was down 2.54%. Now, year to date, we are still green, but barely 1.94%, whereas the S&P is still down 1.19%. And since the start of the portfolio, we are, of course, outperforming by quite a lot. We're up 62.74%, whereas the S&P 500 is up 16.58%. Now in this video, I do want to touch on my winners and some of the losers as well. Go over the upcoming earnings week, talk a little bit about Mercado Libre's CEO transition, and then touch a little bit more on the rising yields, the 10-year, the 20, the expectations for rate cuts for this year, a little bit more on the GDP growth side of things and humanoid robots, and then towards the end talk a little bit more about the future of AR, smart glasses, and all of that. And so if you enjoy this type of videos, hit all the buttons, especially the subscribe button. We're trying to reach 100,000 subscribers, so hit that red button, would really appreciate that. All right, so the portfolio, not much has changed. Again, I'm not in a rush to buy anything. Actually, Saturday's video was talking about the 4 stocks that I will be buying if we get a market pullback and at what prices I will be wanting to add more shares to my already established positions and some of the less established positions. So right now, as you can see, not much has changed. SoFi here is still number 1. Then we got PayPal, Alphabet at number 3, Uber, Micron, Tesla, Rocket Lab, Alibaba, Intel, AMD, Meta, Nebius Group, dLocal. Then we've got the cash position. Celsius, Appcelera, Owlet are all 1% position, if not less. And then, as you know, I have 1 share of Nvidia and 1 share of Palantir. Maybe next time we do a live stream and talk about Nvidia, then I'll add my 2nd share. Now, before talking about the biggest winners and losers of the year, this is what we should be expecting for the next couple of days when it comes to the earnings week. So on Monday, nothing much. Monday, the markets are closed anyways, by the way. So we go and we look at Tuesday. Tuesday before the market opens is a company that I used to own, that's Pinduoduo. I still expect it to do quite well. It is a fast growing company. So Pinduoduo before the market opens will report. I might do an earnings review about that company. And if not, it will just be included in next week's episode. Then after the market closes, we've got Okta in the cybersecurity segment. And then switching to Wednesday before the market opens, you have companies like Dick's Sporting Goods, Abercrombie & Fitch, which I'm wearing, Macy's, and that's about it. But after the market closes, you've got the big one, Nvidia. I did an Nvidia preview video that will be in the top right corner. You've got Salesforce, and Salesforce more recently, there was a report that came out that they were interested in acquiring another company called Informatica. So Salesforce may be here again, maybe sending a message to the street or to investor that, well, they're still going to acquire companies in order to continue to grow. Salesforce is known to make quite a lot of acquisitions over the past decades or so, and that's one of the ways they've become such a huge SaaS player. Then we've got C3AI, ELF as well. I know ELF is on the popular side of the retail community, although the stock did take a hit, but did rebound from the lows, $60 or something like that. For ELF, I think the focus will be on, well, did they regain traction? Because last quarter that was a disaster. Did they regain traction? How's their marketing doing, especially on TikTok? And what will be the negative effects of the tariffs on the business? Because they do focus and, well, they do rely quite a lot on China. So that's going to be a focus point. And then we've got another cybersecurity company here, SentinelOne. So that's Wednesday after the market closes. On Thursday, before the market opens, you've got Foot Locker, Best Buy, Kohl's, and I guess that's about it. After the market closes on Thursday, way more interesting, Marvell, Costco, Dell, Elastic, Zscaler, Ulta Beauty, Gap, if you're interested in that. So Thursday after market closes is also going to be quite interesting, especially for, well, the semiconductor folks. So you've got Dell, you've got Marvell. That's going to be interesting. And then on the retail side of things or consumer side of things, you've got Costco and Ulta Beauty, maybe American Eagle as well could give us more information, but Costco, I guess, is the one that, well, a lot of people will focus on. It's one of those extremely expensive stocks, but also one of those very, very well-run companies and solid compounders. But then again, do you want to pay, what is it now, over 50 times earnings for a company like Costco? I don't know. Now looking at the best performers and some of the losers for the year so far. So far year to date, Alibaba is actually up 42%, while I'm up closer to 40%. Moving on to the number 2, and that's Mercado Libre. That's not in public portfolio, but in the core one. Mercado Libre is up, believe it or not, 42% year to date as well. Actually reached all-time highs a couple of days, I think a week or so ago, over $2,600. So yes, one share will cost you 2,500 USD. It is quite expensive. Again, I know you're going to ask me, is this going to have a stock split? I don't know, to be honest. And I know the question will be, what's in the core portfolio? Well, this is basically it. So Amazon number 1, 24%. Then you've got Meta at 20%. And then you've got Google, Mercado Libre, and Tesla at around 18.7%. And this is basically a portfolio that has been built up over the last 9 years or so. This is one that I don't really touch. It's in an account where the fees are quite high if I sell or buy. Well, if I sell especially, I don't have capital gains taxes, so at least there's that. But it's a platform that still has commission fees, so I'm much less inclined to sell my shares there. Plus, why would I sell shares of these companies? Continuing here on the Mercado Libre side of things, so there is a CEO transition that's going to happen in 2026. That news came out of nowhere, to be honest. So it goes as follows. Hello, I wanted to share with you some news that marks the beginning of a new and exciting stage for Mercado Libre. After 26 years leading the company as CEO, I have decided to transition to a new role as executive chairman, starting January 1, 2026, when Ariel will assume the role of CEO. In the coming months, we will work together on a transition. In my role as executive chairman, I will remain closely involved at Meli. My focus will be on strategy, product development, culture, capital allocation decisions, specific projects, and how we will continue to apply artificial intelligence to transform our business and our company. Now, while I'm sad to see Marcos leave his position as CEO, I think the way he describes this here, him being executive chairman, is him basically saying, look, I'm still going to be fully focused on Mercado Libre and making sure that Mercado Libre is going to be very, very successful in the future, just based on what I'm reading here. And so this transition to me is just him saying, you know what, after 26 years, I'm still very excited about the future of Mercado Libre, but maybe I do not want to spend every single day as CEO of a publicly traded company and deal with the day-to-day stuff. I rather maybe deal with the bigger things that would make this company bigger, stronger, more successful for the future. And I think that's great. And to be honest, the fact that the stock did not really react negatively at all after this announcement was made tells me that, well, the market actually understands this company, because if we're being honest, this is one of the best well-run companies, especially outside of the United States, that I know of. And if we're being real here, if this was a company in the United States, it would have been one of the best companies in the US as well, because management here is key and management is world-class. And so while change probably adds to some uncertainty, well, the guy that does replace him has been at Mercado Libre since 2017. He started in strategy and new business and then led the development of their logistics network throughout Latin America, and for the past 3 years has successfully led our marketplace. He possesses the ability, leadership, the team's trust, and crucially, the culture necessary to guide Meli for many years to come. So yeah, again, zero chance of me selling any single share of Mercado Libre. Moving on to the next one, and that's Uber. Uber is up year to date 38.9%. And me specifically, I'm up 36.6% on that position, which is also why it has climbed to the number 4 position in the public portfolio. To me, I started buying Uber in the low 60s late last year after the stock got beaten down because, well, the fears of autonomous vehicles such as Waymo and Tesla would destroy their business. Now, while this still is a possibility in the long term, if Waymo and Tesla do take 90+% market share, then yes, there will be no need for Uber. But I still think that there is going to be way more players in that market. And yes, I did say way more players on purpose. So what I've also seen over the past couple of weeks and months is Uber making sure that they're well diversified in their partnerships with multiple autonomous players in not just the United States, but in Europe, in the Middle East as well. I think Uber will just be the distribution platform, the one with the network effects, and they're just going to become more and more successful, more and more profitable as well, as we've seen, right? This was a business that was burning quite a lot of cash, and now it's generating billions of dollars in cash every single quarter. Moving on to the next one, and that's a newer addition to the portfolio. Year to date, Nebius Group is up 26.4%, but me specifically, my position is up 63%. Well, yes, because the timing here was maybe lucky, good timing, I'd say. But I've been following this company since the start of the year. At first, I did not buy any shares because I covered it. And then suddenly the stock started to move quite rapidly on the way up. It went just up way too quickly. I was still also waiting for the first quarterly report for the company just to get more information, get a better sense of management. Stock went up, I think, closer to $50. Then we had the DeepSeek crash, and afterwards we've got the April crash, and that's when I finally opened up a position. And of course, yeah, the stock went up quite a lot since then. So I'm already up 63%. But as I said in the other video, I want to increase that position over time, but I'm not willing to chase the stock right now. That's not me saying that today is too expensive. No, it's just me saying that I actually bought a nice amount of shares already in the low $20. Now it's at $38.5. So I have time. And if we stay around those prices, but at least maybe 3 months from now, we get the next earnings report, I get more information, more partnerships get announced, guidance is even clearer, and maybe they're already telling us something for 2026, then that information is probably worth a couple of extra dollars for me. So Nebius here, performance at the moment, very, very good. If it goes back down to 30, maybe a little bit lower, I will for sure be increasing that position. Moving on to the losers here, and it comes at no surprise that, of course, the top 2 position here, which is PayPal, is the one that is down quite a lot. It's down close to 19% year to date. So yeah, we started the year quite well. That's when PayPal was at $90, I'd say. So the fact that PayPal, to me, in that portfolio is number 2, and we've got a couple of other positions that are performing quite well, well, the fact that my number 2 is down close to 20% year to date, of course, drags the overall performance down. But as I keep saying, and you might disagree, and that's completely fine, that's why it's my portfolio and not yours, I keep saying that PayPal is extremely undervalued. Right now, the portfolio is still up year to date, even though the number 2 position is down 20%, and in my eyes, this could go back to $90, and I would still find it not expensive. I actually would still find it undervalued. Now, overall, I am still up 15.4% on my PayPal position. So I'm still in the green, which makes me a little bit more comfortable here because I still believe that PayPal will outperform the market in the upcoming years. Alex Chriss, in my eyes, is doing a very, very good job. The team he has made and hired is doing a very well job in order to revive the core PayPal, let's say, growth and just the PayPal brand worldwide. Yes, in the short term, growth is not really where you want it to be, but I do expect to see some reacceleration of growth, especially from Braintree in the back half of the year. And I think that when that happens, the stock will start to move. In the meantime, they, of course, can just buy back a lot of shares. Remember, they're buying back billions of dollars worth of shares each and every year. And if the stock does not move that much, that means that they can just retire more shares, which means that we as shareholders own a bigger chunk of the company. And if this continues for another, 6-7 years or so, they will be retiring all of the shares that are available publicly. Imagine that. Talking about another undervalued business in the portfolio, but that is also down double digits, in this case 11% year to date, and it's also in the top 3. That's Alphabet. So here again, you can see why I'm only up, let's call it 2% year to date, despite having some big winners. Well, it's because 2 already out of the top 3, and surprise, surprise, the next one is SoFi, which is down 7.3%, but Alphabet here being the number 3 position in that portfolio, me continuing to increase that position because I still view Alphabet as an extremely undervalued and powerful company out there. Well, that's one of the reasons why my portfolio is not doing better than I'd say expected, even though I'm still beating the market. I think we should be doing better, especially in the back half of the year, unless, of course, macro deteriorates, of course. But here as well, fortunately enough, that position is still up. That position is still up 6.3%. Moving on to the last one, and that's of course the number 1 position in the portfolio. And if the number 1 position in the portfolio is down 7.3% year to date, then of course that hurts the portfolio's performance for this year. But as you know, and if you've been following the channel for quite a while, you know I'm extremely bullish on SoFi's future. I know for some of you it has been frustrating. Maybe you want Anthony Noto to talk more with retail. To be honest, whether he talks with retail or not, I couldn't care less. As long as he focuses on the business, as long as he gets us to being a top 10 financial institution in the United States, nothing else matters to me. The company on all metrics, as I've shown you time and time again, goes up and to the right. Okay, tech platform has been a bit slow, but as I've discussed and as they've discussed, 2026 is when we're going to see way more deals that we did not see in 2025, but that we will see in 2026, and that of course adds to the tech platform revenue. So here again, patience is key. Of course, when you start comparing SoFi to another stock, for example, Robinhood, I like the company. I've actually been bullish since $8 when nobody wanted to talk about it, but that's maybe a story for another day. But there's no reason to talk about Robinhood when we talk about SoFi. Different companies. And again, you compete with the market. You don't compete with other stocks out there. Remember that. Now, here with SoFi, what we have is, of course, a case of, well, very good timing, I'd say, although you did have quite a lot of time to buy SoFi under $10, which is why my position here is still up 56.27% on SoFi alone. So yes, of course, I'm very comfortable holding it because I'm not in the red and I'm not only up 5%. No, I'm up 56% on that position. But to be honest, if you've been bullish on SoFi for a long period of time, you've probably been adding at $6, $7, $8, $9. And so you are probably also up quite a significant amount. The only people that are probably not happy with their performance right now are those that bought once at $20 or so and never bought again because the stock went down. And that's the problem. You don't buy a ticker, you buy a business. Okay, you bought an expensive stock, an expensive company at $20. If you liked it at $20, you should have loaded the boat at $6, $7, because at those prices, not only was the stock cheaper, but the business was doing better. That's how investing works. Moving on to the 10-year yield and the 30 is also at 5.03%, by the way. As you can see, the 10-year has been rising over the past couple of weeks, and it did rise quite a lot after that, big beautiful bill did pass the House. Now, why is that the case? Well, why do you buy bonds, right? Why are you willing to get 4.5% or maybe 5%? Well, you're willing to go there. You're fleeing, let's say, stocks, right? Because that's usually what happens, right? If I can get risk-free 5%, why wouldn't I go there? But when you ask the other question, and the other question is, oh, we've just seen that bill pass. That bill is actually going to increase spending. That's going to create a problem when you look at the balance, increase the deficit, increase the debt. How is the US going to solve that problem? And then you're asking that question, well, okay, I'm getting 5% or 4.5%. And you say, actually, maybe I'd like more, right? Maybe I'd like more, which is what we've seen right here, this spike here, and this spike right there. Now, again, 4.5% is still quite high. interest rates are still quite high as well. This is the expectations for the July meeting. In June, there is literally close to zero expectation that we're actually getting a cut. In July, it sits at 23.9%, which is lower than the 30% we had a week ago. Now, if we're looking at the December meeting, we are currently here, by the way, 425 to 450. In the December meeting, as you can see, 39.3% chance that we will already have 2 cuts. 22.6%, 3 cuts. So this is the picture for, at the moment, year's end. December meeting, 39.3%. We will have target rate in basis points that is 375 to 400. Now, how do we deal with this spending issue? Well, Secretary Bessent did say that, okay, we should focus more on debt to GDP. We should focus more on making sure that revenue growth accelerates faster than spending. And that's how you will deal with your debt problem eventually. And so this is a post by Elon Musk. I've come to perhaps obvious conclusion that accelerating GDP growth is essential. Doge has and will do great work to postpone the day of bankruptcy of America, but the profligacy of government means that only radical improvements in productivity can save our country. I had to put here the humanoid robot there. It's probably not going to be just Tesla, but others as well. You increase the productivity, you increase the output, right? Because if you can work 24/7, you're never sick, you don't complain, actually you don't even take a salary, then yes, essentially what you're doing is for sure increasing the output. So accelerating that GDP growth should, in theory, deal with any deficit, deal with debt as well in the long-term future, of course. Now, bear in mind that this will not happen overnight. This will take many, many years. And until we get there, I think it would be smart to make sure that spending does not increase by another couple of trillions of dollars. And of course, the longer interest rates stay high, well, the more expensive borrowing is going to be, and going to be like that for quite a while. So interest rates coming down is going to be crucial here. Now, as we've seen, if we only expect 2 rate cuts this year, and this is something that Tom Lee has talked about as well at the end of last year, the longer we can stay in this rate cutting cycle, the better it will be for the bull market. Because if we only get 2 cuts this year, this opens up the opportunity for another 2 cuts next year, and then another 2 cuts the year after that to get back, well, to the levels we are used to. I don't think we're going to the 0 rates anymore, but if we can get 2 cuts every single year for the next 2-3 years or so, that could, of course, stretch that bull market. Just an idea. Lastly, and this will be very quick because I already talked about this a couple of times this week, we of course had the announcement that Sam Altman's OpenAI is going to acquire Johnny Ive's I.O. company, a design company that apparently they've already worked on the best device that ever existed or whatever, something that will come out next year. Now, Johnny Ives is known for working on the design of the iMac, the iPod, the iPhone, when Steve Jobs was at Apple. For some strange reason, everybody made him a god in design. To be honest, never heard of the guy before that much, and I've checked his work. It's been quite a long time since he actually did something that was really incredible. Plus, as someone said, just because you hire Johnny Ives does not make you Steve Jobs. I think that was a pretty good line. Now, a day after that, we had a report that Apple will come out with their own version of smart glasses at the end of 2026. Now, this is becoming very interesting because we've also had Google I.O. and they showcased their own Android XR and their own smart glasses. But it's not only smart glasses, but it was already augmented reality glasses. And that's the thing. I think smart glasses are great. I own one from Meta. Incredible value, I think. Great value. But AR ones, that's the next step. And to be honest, I don't know, maybe we can put a bet here on the device that OpenAI is working on. I think it's going to be a 0, just like all the other devices that came out. The Humane Pin, the Rabbit R1 or whatever that was. You got 1 week, 2 weeks of hype, and then it completely disappeared. And if we're being honest, the smartphone, in my opinion, is already the best device that we can have. So in order for me to ditch my smartphone, you better make damn sure that your device is much, much better than that. Then, if we're talking about just a device that would augment my experience of a smartphone or whatnot, like the smart glasses, then yeah, we already have maybe smart glasses. So yeah, I don't know. I'm a bit skeptical. That 9-minute video, which I still think was AI generated, that 9-minute video was a 9-minute video about absolutely nothing. And on that terrible disappointment, that's about it. Hit all the buttons, share your thoughts down in the comment section below, and I'll see you in the next one. Bye bye.